And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporates and Investment Banking, turning intent into execution. That's how ABSA are invested in Africa's energy future. 8 minutes after 6. Good evening. Welcome to the program. I'm Stephen Grootes. Interesting results today from Nedbank and the JSE. You'll hear both of their CEOs over the next 20 minutes. Valdene Reddy's the CEO at the JSE. She'll be with you in just a moment. Jason Quinn, of course, the CEO at the Nedbank Group. Interesting to see how things are changing there. They're surprised on the upside, and of course trading volatility, if I can use that phrase, beginning to help the JSE as well. Lots of issues around fake traffic fines, and this is one of those messages that you get on WhatsApp or an email or an SMS. You click on the link and you pay the fine, except that it's a scam, and as News 24 Business explained so clearly today, it's far worse than just losing a little bit of money, because what tends to happen is that you end up actually having someone now having all of your banking details, your credit card details, including the magic CVV number, and then you're in real trouble, and that's really the problem that we have. We'll talk about that tonight. I'd like to hear your stories, by the way, and your advice. What do you do when you get one of those messages saying you must pay your traffic fine? I mean, how do you start? What do you do? How do you know what the link is? How do you know when you must actually pay it? How do you know when you mustn't? We'll speak to Monta Mkalipi, the spokesperson of the Road Traffic Infringement Authority. We'll speak to Craig Pedersen, the head of forensics at TCG Forensics, and we will also speak to Barry Berman, the CEO and founder at Fines SA, about their business. I think those are going to be really quite important. So I think that's going to be quite an important conversation. I've had to tell relatives of mine not to actually pay the fines, even though they say, urgent notice, you must do it, etc., etc., etc. So your advice, please. I'd really appreciate it. On 072-702-1702. I think it really will be quite important. We'll be talking about all of those things. And then don't forget, in personal finance this evening, how to avoid, lifestyle creep. You get a raise, and suddenly you find yourself actually in a position where you're spending a lot more money than you should be. But really keen to hear your stories about traffic fines, please. I mean, I think for a lot of us, you get to a point where the only time you pay, I mean, how bad is this? Is when you can go and check on your bank, because you trust your bank, I hope, or if you're stopped on the side of the road by the police, because you can trust them. I think that's really the issue. And doesn't that say so much about where we are at the moment? Good to hear from you tonight on 011-883-0702 and 0214460567. And of course, don't forget, your voice notes as well on 072-702-1702.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV Channel 856.
The JSE reporting today its headline earnings per share up by nearly 19% in the first half of the year, mainly by big increases in trading activity during the period. Its operating income up by nearly 15%. The CEO at the JSE is Valdene Reddy. Valdene, good evening. Good to talk to you, and thanks for your time. I mean, it's been quite, I suppose, almost a volatile time on markets. There's been higher fuel prices. We've seen mining stocks trading in quite a volatile way. All of this seems to have helped to increase your earnings for the 6 months quite nicely.
Absolutely. Good evening. So you're quite right. South African capital markets actually do very well during hyper-volatile periods just on trade activity. And that has supported our business to deliver a solid set of first half results, but also through other areas of our business that we've invested in. So being a multi-asset class exchange also supports, so it's across most of the asset class segments. And then also seeing a decent underpin from our non-trading income streams. So all in all, a decent result, but really buoyed by that market activity fueled by volatility.
You talk about trying to broaden your revenue base and expanding some of your data offerings. I mean, what kind of offerings are you looking at making? What kind of information would you be, I presume, looking at making available and getting some revenue in as a result?
Yeah, so there's many areas we're looking at diversifying our assets, our revenue streams. So as we mentioned, running a multi-asset class exchange and supporting different asset classes is one of them. And then in our non-trading income area, yes, information services and our data streams is one of that, and I'll elaborate a little bit more. But we also have our JIS business, which is our transfer secretary business, and then also some decent recurring revenue streams that come in from primary markets, which is the annual listing fees. And as we progress our future strategy, enhancing that diversification through data and tech ecosystem is one important area. So there's many areas specifically in data in which we look at. We've invested over the last 5 years in not just getting our data into a more safe and scalable digestibility, but also the ability to drop in analytics products on top of the core exchange data that we have. Now we're looking to expand that further, ancillary data services that would support the business, that could serve a broader client base. So things in the data analytics space, things in the RegTech and software as a service space. So we're building out from exchange to ecosystem and really looking at how we can deepen our product set in data and technology and serve a broader client base.
I mean, you say you're going to use this cash position to fund your strategic investment. It's come at a pretty good time for you then.
Absolutely. I think, it's not just about taking excess cash to use it to fund growth, but also to demonstrate cost discipline. And I think that's the other thing that this result shows, such a fully fledged comprehensive result. It's just not based on market performance, which, as you know, is out of our control. So while the tailwinds support us, we need to have a resilient business and one that is future fit. So the cash balances, the JSE maintains its healthy cash balances. And we are committed to grow the business, but not at a cost to the shareholders. So where we can also just return decent cash to shareholders. So disciplined capital allocation will be a massive focus for us as we grow the strategy. We're a strong dividend stock. Returning cash to shareholders and shareholder value is an important imperative. But to use some of that proceeds of the cash to fund growth and opportunities.
You've been trying to make it easier and cheaper for companies to list. You've removed some of the sort of more onerous and regulations that were seen as unnecessary. Some new firms have come onto the exchange, of course, Veldine. How much road is there to continue that process? I mean, it was a big program you ran. It seemed to have some success.
Yeah.
Are you kind of out of road on that? Do you need to think again, or do you still have some more space to go?
Well, I don't know if it's a very loaded question. So if we're out of road on that means there's no more opportunity and we've done a great job, or if we still have road means there's still so much we can do. But actually we've done a whole lot, as you said, but really it was under the ambit of really making the appeal factor of South Africa more competitive. Secondly, to make sure we're globally connected, and we've done a lot in alignment with the fast track listing process to global jurisdictions. And the third was to have appropriate and relevant listings. We just recently did the revisions on the debt listing requirement. So I think it's ongoing to just be responsive to the market. We want to maintain, one of the things we've built over the last 140 years is that credibility of the reg framework and, trusted markets. So we don't want to go down to, very open and loose markets. So there's a balance. But also making sure we're attractive and have the right products and the right environment. So there is still a little bit more to do, but I think it won't ever be graduated to be complete, because there's always relevance in what matters in cycles. And being responsive and appropriate, I think, is the ambit in which we will keep growing and refining those regs.
Veldine Reddy, thank you very much indeed. The CEO at the JSE. Interesting to see the changes that are coming through, and stock markets around the world really are in one of those big transitional phases, it seems to me. 17 minutes now after 6.
The Money Show with Stephen Grootes
On 702.
702.
Nedbank reporting slightly better than expected results in the first 6 months of the year. Headline earnings up slightly, just 0.1%, but it had previously said its earnings might actually be down because of the sale of its stake in EcoBank, so it's surprised on the upside. It does seem to perhaps have been able to take a bit more of the loan market. Its impairments are up slightly, though. Jason Quinn is the CEO at Nedbank. Jason, good evening, and thanks for your time. Your home loans are up by 6%, and when you consider house prices in so many parts of the country are not really moving at all, are you seeing something happening with demand for mortgages?
Yeah, Stephen, thanks. And let me also just say thanks to your listeners this evening for dialing in. Stephen, I think just to go back a step to your first opening statement, which of course is entirely accurate, I would just add, though, that, selling Echo Bank, which we did in the second half of the year, was an important strategic move. But in the first half of last year, we had just about R1 billion worth of equity accounted earnings, so non-cash earnings from it. So we kind of had to make that back to stay flat. And if you look at the underlying performance in Nedbank for that first half that's just behind us now, our diluted headline earnings per share, just adjusting for that item, is about 15% up. So I think that speaks to the underlying momentum. And then just leading into the lending books, as you mentioned, we've seen pretty good momentum across our lending, whether it's in CIB, up 8%, BCB, business commercial banking, business we kind of started leading separately a year ago. That was down 2% first half last year. First half this year, it's up 6%. To go to the mortgage book, look, we've had strategies in place now for 2 years, being with mortgage originators and very long-standing, partnerships that we've built out. And that's given us the growth. I would say, though, Stephen, that the mortgage market's been relatively buoyant for the last 2 years across the country. Even in Johannesburg now, over the last year, we've seen steady increases in house prices and renewed demand, such that many estate agents are actually struggling for stock at the moment. So there's a bit of buoyancy there, despite all the headwinds we face. Mortgages are doing fairly well. I mean, auto is for us, leading product, very high share, great partner in Motus. And there we grew loans like about 9% and defended our leading share. And cards, a product that I said 2 years ago would take us 2 years to get back in the market on. We got back in now and loans are up nicely there as well. So just evolution of executing a strategy well, Stephen.
Your business and commercial banking revenue is up by 6%, and you bought the iKhokha group during the period, and that tends to focus on smaller firms. How are you seeing demand for from smaller firms for loans? I mean, particularly companies maybe wanting to scale up or grow their businesses a bit.
Yeah, Stephen, that's another little hidden gem in our economy. Let's say for a minute that, the consumer pressure emerged a bit in the second quarter. And let's say that at the corporate level, there's cash flush businesses across the JSE without huge investments at the moment and without huge lending appetite. But let's just say, though, that if there's growth in the economy that's stronger, it's in that small, medium enterprise layer, mid-corporate commercial layer. And that's really one of the strategic reasons why we pulled business and commercial banking out. Acquiring iKhokha is part of that. In that 6 months just behind us now, we did a load of work to kind of execute strategy, but there's much still ahead of us. For instance, now we've got 150,000 point of sale devices out there, up 55,000 in the half with iKhokha in. And Stephen, the nice thing is, those are all in areas where Nedbank wasn't necessarily present, the township economy and these sorts of areas. And that's caused a lot of, growth. And now the step ahead of us is that we'll be commercializing that opportunity through lending products on the back of the very rich data we get off those devices. That's still ahead of us. Others that we've already made progress on, like you can get those iKhokha devices in all of our branches now. But there's a really slick distribution model in place at iKhokha. And so, I think we're kind of executing against that strategy really well at the moment in that segment.
Your impairments are up a little bit. Is that just a sign of our difficult times? Is it a sign of just more loans that actually are out there and therefore you'll have a bit more impairments?
A bit of both of those factors, Stephen, that if you just step back and look at the half just behind us, Q1 was pretty much on track from a macroeconomic perspective. We all came back from Christmas and the outlook was fairly constructive for the world and for SA. That disruption of the conflict in the Middle East transmitted very quickly into inflation in the consumer pocket. Like the very next petrol station visit was up 30%, and it's still going up tomorrow. So in Nedbank's books, clearly, as you build loan portfolios as we are, you also build some coverage against that on forward-looking assumptions. We've taken a set of forward-looking assumptions into our models this half that builds coverage because, of course, interest rates are up, inflation's up, and growth is down. So we've built a bit of coverage related to that. We've got some new loan growth. I'd say, Stephen, it's also, to be fair, impairments are up in our personal and private bank, let's say the consumer segment. Whereas in CIB, corporate investment bank, we're actually seeing almost no impairments at the moment. And in BCB, we're at the kind of bottom end of our range. We said coming into 26, Nedbank had done a great job to get loan losses down over the last couple of years from the highs of coming out of COVID in 22 and 23. So we were all the way down to 68 basis points at the end of last year in a range of 60 to 100 basis points of appetite. So we were probably at the bottom end of it, and maybe it was even too low. So we knew it would go up. It certainly went up a little bit more in that first half than we thought, and some of those factors probably remain. If you look at the macro assumptions we've taken, but we do expect an improvement in that ratio in the second half. Well, firstly because of seasonality, and secondly because of all the efforts we're putting in with our customers to support them in the stress we're having. So we'll print a better number on that by the end of the year.
You've been able to contain your expenses. I think they're up only 3% now, and that's well below inflation. Inflation is going up, and I'm sure your employees will have noticed, Jason. Is it going to be harder to keep your expenses at that kind of level, unless, I suppose, you got AI or something to do some jobs currently occupied by people?
Well, look, I mean, there's different components of our cost base. Stephen, if you look at it, around about 55% is what we pay our staff. Then you've got about 15%, which is technology. Then you've got all the physical infrastructure we own and a bunch of other costs. So I would say to you that, 2 years ago, we set out a productivity plan across the company on the back of good work Nedbank had done for a very long time before that. The organizational restructure that we did this time last year has also generated productivity benefits, which are all sustainable. So we're pretty comfortable that our cost growth will remain low. In other words, we've guided for below mid-single digits for the whole year. And we think it remains low into the future, Stephen. Of course, we've got pockets of real investment like many companies. Within that, technology investments are still pretty high, and we're sort of investing in a new digital banking app, and some of the first releases of that come out like in Q3 on an online share trading platform, which will be amazing for customers. So there's pockets of investment within that. Also, I'd say to you, Business and Commercial Bank is a business we invested in heavily over the last year. Investments there, I think costs are up 11%, and that investment curve is behind us, and the revenue curve is ahead of us. So, I think you've come to know me over the years as someone that turns the penny, so to speak. But there's a lot of productivity gains in Nedbank at the moment, and those are sustainable.
Jason Quinn, the CEO at Nedbank, really appreciate your time tonight. Thank you.
The Money Show.
The markets.
25 minutes after 6. Marco Staffio is the head of Global Markets Institutional Relationship at ABSA CIB. How's it, Marco? Good to see you. Thanks for coming in. So let's start, obviously, with Nedbank. Jason Quinn, quite bullish. You would expect him to be. They've done slightly better than, actually quite a bit better than expected.
Absolutely, Stephen. I think the biggest thing there, what the market really liked, is that they're generally delivering on the targets they've set themselves. So, some fairly ambitious targets over the last couple of years, and they're really coming through quite nicely.
It's interesting to watch their loan books seem to be improving. I mean, an interesting comment that he suggested that in Joburg, actually, there was quite a lot of movement. There seems to be a bit of buoyancy in the economy despite it all, and there's a lot of it all.
Absolutely. Look, I think quite purposeful on their behalf. I think, as you heard him say on the interview there, working with mortgage originators, trying to, broaden that net a little bit. Nedbank in the past very much known to being a sort of corporate bank rather than the retail bank. So I think, very purposeful strategy that's playing fruit. But, I do think you're seeing a little bit of buoyancy in the Joburg property market.
The movement through iKhokha into sort of new sectors of the economy, the township economy as it's often described. I've yet to come across a better title. At least it's geographically correct, I suppose. That obviously would seem for them, they're perhaps a little behind some of the other players in doing that, but they certainly have a lot of room to grow, I would think.
Yeah, absolutely. And I think a lot of market participants questioned when they did that iKhokha deal, basically saying selling out of Africa, buying, in what seemed like quite an expensive multiple into a business that wasn't the number one leader in the space, but now starting to come through. And I think you're seeing it in the results. So, quite good to see that coming through. I think the other thing that the market did like was those positive jaws coming through. So we saw that cost income ratio come down quite nicely as well. And based on that, very good cost control.
The JSE itself, obviously this is a great moment for them, strangely. Lots of trading and therefore lots of fees, and they've got some money to invest.
Absolutely. Look, I would argue there was probably more in Q1 than Q2. I think things have slowed down towards the end of Q2. We got the the truce, then no truce, then more truce.
Yeah.
And we see that, the markets tends to have got a little bit slower to reacting to those, big pieces of news flow. So at the start of the war, any piece of news flow came out and you would see lots of volume go through. I think that has slowed down, especially to the back end of the second quarter.
Platinum price surged, 6% while the JSE was in session. What's behind that? I couldn't see one specific cause. Somewhere at the back of it, is it all about oil?
It feels like it's all about geopolitics, really, Stephen. I mean, we continue to see these headline-driven moves. As I say, probably less trading on it, but we saw the underlying stock prices or the underlying metal prices move, which drove the stock prices higher. Valterra up as much as 10% today, but really just feels like a risk-on day. We saw the rand stronger, oil down, basically everything that tells you, risk-on trading back to the fore.
The question, of course, is how sustainable is it? And I mean, platinum in particular has been very volatile over the last couple of months.
I think that's left a lot of market participants scratching their head. There are some arguments to say that supply might have some structural issues, particularly in Russia, and demand is looking okay. I mean, new vehicle sales in the world not looking that great. So I'm with you. I think that there are lots of question marks around that sustainability of the rally.
A little bit of a rally in the US, the S&P 500, a new intraday high there, largely about AI optimism once again.
It seems so. I think, the two risks that have sort of been front of mind was one, geopolitics. I think we've spoken about that a bit. But the other thing, a lot of people asking if AI investments are going to generate returns. So Microsoft and Amazon over the last couple of days coming out and showing good monetization of their investments, 10% gains in both of those shares. Last night we had Palantir come out and again a good set of results and raising their guidance. So all pointing to the potential of CapEx actually doing what it should be. And then surprisingly, I mean, one I don't think I'd ever think I'd mention on an AI trend, but Caterpillar doing quite well as well. Ultimately for the infrastructure build around AI and data centers.
Amazing how all of these things are connected. What do they say about the world? Marco, thanks very much indeed. Marco Stathio is the head of Global Markets Institutional Relationship at ABSA CIB, bringing the time to 6:30.
WhatsApp Stephen
On 072
702
1702.
One or two messages about what's been happening relating to fines, and I asked you for your stories about that. Tsakani says, I visited the Road Traffic Infringement Agency yesterday. I'd paid more than 7,000 rands in fines. I still could not renew my driver's license and disc for my car. It was part of an he suggests, this is Tsakani saying, the car was part of an e-hailing taxi. The driver had accumulated a whole lot of fines. Having paid the fines with enforcements, then I was able to renew my driver's license and disc for the car. I had wanted to make an arrangement for the other outstanding fines, but was told it can't be done. Sure, somewhere along the line there's supposed to be a change of ownership, and that's not supposed to happen. You're not supposed to be held liable. With cars, it's not the owner, it's really not the owner, it's the driver who's supposed to pay them. You can't, get an owner to drive more slowly, if you see what I mean. It's got to be about the driver. So that was the original aim of traffic fines. And I know we've heard people say, actually, it's just become more about making money than anything else, perhaps. But your thoughts, please. We'll talk more about it in a moment. 072 702 1702.
702 with Stephen Grootes.
Email him on stephen@702.co.za.
18 minutes now to 7 the time. Well, a new warning today from News 24 Business about the huge surge in traffic fine scams. And in fact, what can happen if you get an SMS from someone claiming to be from some arm of government, you click on the link to pay the fine, the people at the other end are literally able to get all of your bank account details, and you can imagine what can happen from there. We'll speak to Barry Berman from Fines SA in a moment, and Craig Pedersen as well, the head of forensics at TCG Forensics. But I want to start with Monde Kalipi, the spokesperson for the Road Traffic Infringement Office Authority. Monde, good evening, and thanks for your time. I mean, I think it's one thing to click on a link and pay a couple of R100 and realize we've been scammed. The problem is the situation is much bigger than that. What kind of impact is this all having on your operations? I mean, it must be happening all the time that people think they've paid you, and in fact, they've paid someone else.
Good evening, Stephen, and to the listeners of 702. Thank you so much for the opportunity. Yes, it is very much prevalent, Stephen. And, as the Road Traffic Infringement Authority, we really had to come up with ways of ensuring that, we contain this type of a problem. Yes, it does affect our work so much because now and again we get road users who will call and say, I still see that my infringements are still blocking me from renewing my driving license, and yet I had made the payment. So we get those calls quite a lot. And we always say to the road users, ask the question, where did you make the payment? Because as the Road Traffic Infringement Authority, we do have approved payment platforms, which we encourage road users to make use of. Well, it does affect our operations, and we always call upon road users to say, please go and look for the official and approved payment platforms of the Road Traffic Infringement Authority. It's a huge problem, especially when huge announcements have been made, Stephen. Like recently, the proclamation of the rollout of AARTO in the 60 more additional municipalities. Well, there is quite a lot that is coming up. And what we also encourage road users to do is that they need to perhaps screen grab some of this information and email it to us so that we're able to track it. But over and above that, Stephen, from our side, we also call upon road users to really be very much vigilant. We issue regular media statements to call upon them to really check before they press any or click any link on the internet. It's quite very much important that they do that. Yes, Stephen.
I mean, Monde, the other consequence, the other thing people must do is that when you send out infringement notices, they just ignore you. I mean, I'm sorry to say this, and I don't mean to be rude, but if I got an email from the road claiming to be from the Road Traffic Infringement Authority, I wouldn't open it. And I'll tell people in my family not to open it and certainly not to click on the link. Now, you might be sending it to me in good faith, but I have no way of knowing nowadays.
Yes, it's always important when perhaps you receive such information to avoid a situation where perhaps the system, that is the AARTO system, you end up being blocked perhaps for legit infringement notices. We always encourage road users to really verify such information. They should please call us and visit perhaps our website to really check the authenticity of such emails. And above all, for example, now we're working with the post office now very, very closely. And instead of just sending out an ordinary SMS, as part of their SMS, that is the colleagues at the post office, is to include our our website address as well as our contact number, that is the call center number. Meaning that if perhaps the email comes through during weekends, because this is the other feature of these emails, Stephen, they come in at very awkward times where perhaps you are urged to press and immediately to qualify for 50% discount or to avoid court action or something like that. So please verify, go to the website if it's after working hours, or call our call center number where you can verify this information during working hours. It's quite very important because it really destabilizes our operations. It plants a lot of information that is incorrect about what we do as the Road Traffic Infringement Authority.
Monde Mkalipi, thanks so much. Spokesperson for the Road Traffic Infringement Authority. Craig Pedersen is the head of forensics at TCG Forensics. Craig, good evening. So I would imagine that once you've made a payment to these crooks, they suddenly have all of your bank details, and goodness knows what can happen after that.
Well, Stephen, yes. It's what we call a baiting scam. I mean, if you think about it, the amount of technology and work that goes into running this particular scam, it's hardly worth doing it at 250 Rand a victim. But when you consider that most victims are going to pay by card, you now have their CVV, their expiry date, their name. And if they're using a physical card to pay for that infringement, the next thing that's going to happen is they're going to be running transactions against your card. The only way to avoid that, of course, is first use places like PayFine that are registered, acknowledged, and reputable. Secondly, use a virtual card. Do not use a debit card. Do not use a physical card to pay for those infringements. They're not after you $250. They are after your card details.
The CVV number, which is the number on the back of the card, and so often if I go and buy something online, it'll have my card, my computer remembers my card, but the CVV number I have to put in each time. What's so magic about that number? How does that number protect my card from fake purchases?
Well, the CVV number is used to authenticate your card during the transaction. and it's not stored on the provider. So a Takealot, an Amazon, a good vendor would never store your CVV number. It's part of the protocol. There's no need to store it. You just put it in every time and off you go. But we've seen too many of these sites where they pop up, like the current one that's doing the rounds. You click on the link and it immediately fills out everything, tells you got a 250 Rand fine and gives you a credit card link to pay it. Now that link is not going to a proper gateway. We've even seen this where it doesn't even take the 250 Rand from your account. It mines your card data so it can be sold to people who practice a thing called carding, where they download viable credit card numbers in list form, and they just create their own cards, imprint them with the data, and they go shopping.
Sure. We've actually had an expert in cybersecurity come into the studio and on his laptop in front of me go onto the dark web and show me where he can buy credit cards. I presume your card can end up there too.
Absolutely. That is exactly the point. So what you're seeing now is how your card number ends up on those lists that are sold over the dark web.
How can you keep your card safe? So use a virtual card. I'm not even sure I know what that is.
So virtual card is issued by most of the banks these days, and it's a card that basically isn't in physical form. They issue it to you, it's stored on your phone, and the CVV number changes with every single transaction. So rather than having a physical card, you call up the app on your phone, you have your normal card number, which stays the same, but your CVV changes with every single transaction. So even if somebody does get and store your data, it doesn't help them because the CVV number is already changed.
Okay, so if the money is stolen, is there any way at all to get it back? I mean, sometimes banks can, if it comes from a credit card, can get the payment reversed. I have no idea how they do that.
Yes.
Sometimes they can't.
Okay.
Does that work?
Absolutely magic question. This is the difference between credit card, debit card. A credit card transaction is generally insured, and within the window of, I think it's 60 days, you can have that transaction disputed and reversed. But if you're paying by debit card, it's a debit. It's gone. It's not reversible. What we see a lot of is the card numbers that are harvested are used for cash withdrawals around Europe. So people in Europe will get those numbers, run off cards, they go down to a local money merchant, and they do a cash advance on the card of 10,000 Rand, 20,000 Rand. We've seen this go as high as 350,000.
Sure.
And they just keep hitting that card. And of course, again, if your card has a very high limit or no limit, well, that's the feeling that they're going to go for. So the alternative to a virtual card, get a savings account, get a card attached to it, put 5 grand in it, and set that as your threshold. If that card number gets stolen and used somewhere, your maximum exposure is 5 grand, and just top it up as you need to. But your physical day-to-day card that you're using should not be used online.
And then the other thing you can do, and we should all do, and once saved me a huge amount of heartache, is just checking your credit card literally every day on your bank.
Yeah, absolutely. You know, we are so used to tap and go convenience that the days of people sitting and reconciling their checkbook or reconciling their credit card statements are gone. People just take it on faith. They get the magic ping on their phone, and they forget that you still have a floor limit. And if your floor limit is set at, say, don't SMS me if it's below 250 bucks, you can run a lot of transactions at 200 Rand until you deplete the account. And once those transactions are run, they're run.
Craig Pedersen, thank you very much indeed. Very sobering. The head of forensics at TCG Forensics. You're with the Money Show doing a deep dive into traffic fine scams. 7 minutes now to 7. Barry Berman is the CEO and founder at Fines SA. Barry, good evening. I mean, these fines, these people must in some way affect your business. Do they maybe actually drive a lot more people to your site to check their fines?
Yes, Stephen. In actual fact, what happens is that our call center is taking a huge amount of calls, and that seems to be growing month on month. These are people that are concerned. They do smell a bit of a rat in the communications, and they're phoning in, and most of them are actually not part of the Find SA platform. You know, we have about 2 million signed up customers who use our platform, whether it's the app or the online platform, to check, verify their fines and pay. So then, you know, those motorists who do phone in, then we encourage to download the app, because that is probably the safest way to make sure that when you're paying your fine, that it is going into the right place, and ultimately, you know, that fine is going to be settled with the municipality, which is very important.
Do you see a seasonality to the visitors to your site, people checking fines? I mean, we heard from Mondem Kalipi earlier about when AARTO was being extended to more municipalities, for example, they had a lot of queries. Joburg went through a time when none of its speed traffic cameras were working. I wonder if people just didn't bother to come and check their fines during that period.
Yes, there are definite seasons. So because of the rollout of AARTO now, there is a lot of talk about it. So, you know, all of those new municipalities, we're getting a lot of customers signing up there because, you know, that's been in the pipeline for 15 years now that it is reality. People are waking up that they need to actually sign up. Also, just bear in mind that the Postal Service doesn't always deliver the mail, so you don't actually know that you have an outstanding fine. And then before you realize that it is escalated and you're blocked. So that is one of the seasons. I mean, historically, because we've been in the business now for over 20 years, you know, the busy travel periods, Christmas especially, where there are lots of roadblocks, we get, you know, a lot of sign-ups. But what Find SA has been doing for many years is that we proactively send our client base a monthly statement if they have outstanding fines, which is quite useful, because then they get the benefit of the discounts, because the earlier you pay, the more you can save, and then the fine doesn't escalate, so you're not stopped at a roadblock and then you have a warrant. So we do proactively work with our client base, and I would encourage motorists, fleet alike, to sign up, and then then at least they know that they are in the right place.
Barry Berman, thanks very much indeed. The CEO and founder at Fines SA, and before him, you heard Craig Pedersen, the head of forensics at TCG Forensics, and starting us off on that, Mondem Kalipi, the spokesperson at the Road Traffic Infringement Authority. Just a reminder about how often you need to go into your accounts and just check the payments that have come off your, especially your credit card, but all of them. Just go and check. I think it's becoming more and more important to just make it part of your daily routine. Really, I think a good idea. 3 minutes now to 7.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking, turning intent into execution. That's how ABSA are invested in Africa's energy future.
Been thinking a little bit through the afternoon about what Patrick Lamini will do now. He's the CEO of the Public Investment Corporation. He was suspended, a court today ruling that he must in fact be reinstated. It did make me think that if you're him, if you've been treated badly, you probably do want to go back. You've got a new board there. You might think, well, actually, there's some people I can work with, and that is what he wants to do. I mean, presumably he wants to be involved in the PIC. And then also, when someone is suspended and then goes back, they in some ways have quite a lot of power. I think it's going to be very interesting to see what happens next there. Impossible, I think, for the board to say, no, you can't go back. I mean, the CEO doesn't change just because a board does. We're not finished yet with the PIC story, would be my sense. And I'm afraid still we don't see any kind of changes coming to the actual structure of the PIC board, which I'm afraid is a bit of a pity. A lot more in a moment. It's just gone 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking, turning intent into execution. That's how ABSA are invested in Africa's energy future. Plenty to come in the next little while. We'll hear from Nicole Martins. She's the Executive Director at Just Share. And this, of course, will be looking at what happens with greenwashing. You hear quite a lot of that, actually. We need to be very careful of it. We'll hear from Professor Rutindo Ndingwi. In fact, I think he's sitting, and recognize the cap. There he is. Yeah, that'll be him. And he'll update us on what's happening around our continent. And then don't forget Warren Ingram. Lifestyle creep how just because you're getting a bit more money doesn't mean you're actually going to be richer. What happens when you start to buy things that you don't really need? There's a wonderful phrase about South Africans, which is that we buy things we don't need to impress people we don't like with money we don't have. I've always thought that's a wonderful way of sometimes summing up the situations we get ourselves into. Good to hear from you as well on 011 883 0702 and 021 446 0567.
WhatsApp Stephen
On 072
702.
1702.
I asked for your traffic fine stories, and I suspect that you or someone in your family may have been in a very similar position to this person who had an absolute nightmare.
Hi, Stephen. What happened with me is that I used to work in the motor industry, and being in sales in the motor industry, you get a company car. And since that time when e-tags were introduced, the dealerships came with a strategy that they register your company car in your own name so that the e-tags as well as other tickets come in on your name. But the problem is that after 3 months, when you have to change that car, or if that car is sold before it gets out of your name, for example, you come to buy that car, get delivery of the car today, and then you drive home to KZN to go and show granny and grandpa. And at that point, the car is still in my name. You're getting tickets, you are enjoying your GTI, you get tickets, but the car is not out of my name yet. So I had 8 tickets that were in my name. And with this fraudulent infringement that they always send us mid-city, what, you have a fine. I thought all of these are scams, because I have received an email talking about them from Mid-City, and I thought because I'm getting all other emails, I thought it was a scam. So I didn't follow them up. When I needed to renew my license, I was told I have 8 infringements which I had to pay for, which cost 6,000 for tickets that are in KZN, where I have never even been. I think it's 12 years since I've been to KZN, and I tried to explain, tried to do anything, and the dealership that I used to work for where that car was sold to another brand, and a lot of stories. And I drove 2 months without a license while I tried to get money in order to pay those tickets, 6,000.
Good afternoon. So with regards to the traffic fines, first things, obviously check the link. Secondly, where it asks for the registration number, if you enter in any random garbage and it still goes through, there's your second red flag. So the first thing I always do is check on the registration number. But what made it a bit of a hobby recently is track down the website registrar and then have the website taken down. That's quite fun. Anyway, Ivan here from Spring.
Ivan, that's a great way to have fun. I like that. Thank you. And then, the previous person, you didn't leave your name, sir, but I hear you. And I did think to myself, sure, so many people have similar stories where you just get caught up in the paperwork. 12 minutes after 7.
702. Stephen is on The Money Show.
6 to 8 p.m.
The Green Economy feature on The Money Show is brought to you by Volvo. Relax and test drive a Volvo plug-in hybrid today. Well, I'm sure you've seen many financial institutions. They like to make a lot of noise about the fact they're investing in renewable energy, and the presumption is this means they're using less carbon, they're financing less carbon, and as a result, the economy is using less carbon. We'll just share. They say that may not be the case. Nicole Martins is the executive director there. Nicole, good afternoon to you. So they're the glossy websites and the sort of focus on this, particularly from financial institutions. You suggest there's something maybe they're still missing, something we need to check on a little more deeply?
Yeah, 100%. And thanks for having me again, Stephen. I think one of the things we need to test is whether these banks are actually transitioning versus just increasing their investment in renewable energy. And those are two very different things, right? If you think about it, if I wanted to lose weight, I can't just eat more vegetables. I have to also eat less chocolate cake, right? And it's sort of the same approach here, is that if these banks are interested in a transition, so real world impact, getting those emissions down in real terms, then they can't just keep investing in more renewables and maintain their investment in high carbon assets. So there's a couple of critical questions they need to be asking about their strategies before they start talking about how amazing they are and all the good that they're doing.
So, some people might just be using a lot more energy and actually emitting more, despite giving you the firm impression they're going the other way.
Yeah, that's definitely true. And that's why banks need to be engaging with their clients to say, are you on track for a science-based, credible transition plan? So, we understand these things don't happen overnight, and the banks play a really critical role in investing in the capex that's needed for these assets to transition. And so the question is that happening, right? So while we are putting all this money into renewable energy, and we're simultaneously financing the high emitting assets, are those high emitting assets actually, decreasing emissions in absolute terms over time?
How can you go and check? The annual report's often as glossy as the website with a picture of a windmill on the cover.
Yeah, I think that's the tricky part, right? Is that not just banks, but most big companies are very good at communicating the good that they do and their sort of positive impact. But it's when you scratch a little bit under the surface. I mean, one of the interesting things to do, for example, if you've got spare time and you aren't busy taking down fraudulent fine websites, I think one of the things that you could do is you could definitely go and have a look at the sustainable finance target, for example, or the renewable energy financing figure over time. So usually it will increase in absolute terms. When you correct that for things like inflation, is it actually increasing or is it going backwards or staying the same? Similarly, when you look at it as a percentage of the loan book. So yes, in absolute figures, I'm spending more on this thing, but in terms of how much I'm spending in general, is it actually significant and is it growing over time or is it staying the same or going backwards?
I mean, it's a funny thing about companies, and this is a comment really about so many of them, but they all can sometimes spend a huge amount of money massaging numbers rather than just making a real change. And, it might be sort of what some people call greenwashing now. It was other things before.
Yeah, and that's a really sad thing, actually, is that in many cases, we want to believe that it's a case of misunderstanding what a transition really is, right? So if you were to give the organizations the benefit of the doubt and you'd say, okay, maybe they don't actually understand what it means to transition your assets or transition your loan book. But more often than not, they fully understand, and they assume that we as stakeholders that are reading these reports don't. And so they communicate things that will make them look good. They focus on those headline numbers, on big targets and commitments, and try and one-up their peers. But they're not actually changing anything on the ground in terms of business as usual.
Are there ways to put more pressure on them? I mean, does this ever come up in AGMs and things like that? I imagine for a lot of shareholders it's on the list, but it's pretty far down on the list of things to bring up.
Yeah, I think where it's gaining traction is when you think about the risk that it poses, right? So not only is the absence of a credible transition plan a risk in terms of the sustainability and the resilience of that asset, so of the bank itself. So it needs to have that plan in place, and its clients need to have those plans in place in order for that bank to remain sustainable over time. But it's also a reputational risk for the investors, right? So when I'm buying shares in one of the big banks and one of those banks is claiming to be a responsible bank or a sustainable financer, and then they happen to finance massive oil and gas projects or huge emitting assets, then I look a fool, right? So I think that when you speak about it as risk, it is starting to come up more and more where the walk is not matching the talk. And that presents a significant reputational risk. It presents litigation risk. It presents risk, obviously, to the financial return that you can generate over time. So I think the risk conversation is starting to gain real traction.
Is it worth someone somewhere starting a conversation about changing reporting requirements on this sort of thing? I mean, we all want companies to be honest. We all know that it does from time to time require a little bit of, pulling to the water. I mean, could the JSE get involved in that? There are already quite a few other requirements, so they might be a little wary of it.
Yeah, I think that there's definitely room to increase the disclosure requirements. I mean, it could come from the JSE, it could come from other regulators. I think requiring that financial institutions and other companies in other sectors have got a credible transition plan that aligns to, at the very least, aligns to the national developmental agenda, I think is not beyond the grasp of regulators. I think it's really a question of where do you start? I know that the Prudential Authority, for example, has done a lot of work on what would be the metrics we would be looking at if we were to be assessing this risk properly, but then they don't follow through and make it mandatory for banks and insurers. Or the FSCA, the Financial Services Conduct Authority, they will look at sustainable finance for financial institutions, and they'll focus on consumer protection. So they look at, you can't call something transition or sustainable or impact or green and not be able to back it up. So the kernels are there. They just haven't quite germinated in terms of policy and regulation. But I think we're approaching a point where we will need to start intervening in how the capital markets operate.
I mean, you would like to think that investors themselves don't like being lied to. But I know for a lot of people, and I can understand this, the bottom line is what really matters.
Yeah, of course. And I think, we fall into the trap of thinking that the role of investors is to solve for all social ills, but their role is to generate value. And where the conversation gets interesting is where we have increasing evidence that integrating sustainability considerations into the way that you allocate capital is actually benefiting value creation. It's actually in your interest as a prudent investor. And so as we get more evidence, as we get more data, as we see the costs of, I would say you could call it the costs of non-compliance, right? When you fail to mitigate an ESG risk, or when you fall into that kind of trap, when you haven't actually taken these things into account, you always end up paying for them later. We see that in every governance scandal. If you think about VW, about the BP oil spills, if you think about Facebook and its sort of data issues. So I think as soon as you see the costs that are associated with these risks, then the conversation is about value creation. It is about that bottom line, and it's intrinsically linked to sustainability.
Nicole, thank you so much. Nicole Martins is the Executive Director at Just Share. Relax. You're okay. The new range of Volvo plug-in hybrids gives you more than 80 kilometers of pure electric driving in a combined range of over 800 kilometers. Plus, every time you brake, the regenerative braking system helps recharge the battery, making it unlikely you'll ever be far from enough power to get where you're going. And if you do need to top up, you're never far away from a petrol station or a charging point. For added peace of mind, every Volvo plug-in hybrid comes with an 8-year battery warranty. So put your range anxiety to rest and test drive a Volvo plug-in hybrid today.
The Money Show, Africa Business Focus.
Professor Rutundu Ndingwi, someone whose glossy website you can trust. He's the founding director of Tribe Africa Advisory and author of the book Rumble in the Jungle Reloaded. How are things going?
Not too shabby. And by the way, I don't dress to impress you, Steve, because
I know.
because you are my friend, so I don't have to dress smart to impress you. So I was just picking up from your last statement. Otherwise, I'm well, Steve, and a good evening to you and your listeners.
Okay, let's start with Russia. They've shipped 2.9 billion rands worth of agricultural products to Africa. I mean, Ukraine's also been campaigning hard in Africa, but Russia's exports are rising.
Yeah, someone once told me, Stephen, that geoeconomics will always trump geopolitics. And this is a typical example. Albeit there's a war between Ukraine and Russia, Russia's exports have increased by 40% in value into Africa, and on average by 35% both in value and volume in Africa in H1, which is about $2.9 billion. The dominant export from Russia into Africa, funny enough, Stephen, is wheat. 90% of it is wheat, and the remaining 10% is barley, soya beans, oil, and molasses. And the top 3 countries mainly importing from Russia are Egypt, Sudan, and Kenya. They make up 44%. So it's quite interesting. They actually had a bumper harvest. So all things besides what is happening in Russia and the Ukraine war. And remember also Ukraine is a big supplier of wheat, but from a geographical perspective, they're in the same sort of zone. But it just highlights that the deepening engagement between Africa and Russia from an agricultural perspective. I guess at the end of the day, we have to eat, but Africa obviously has the potential to produce for itself. And 40 countries in Africa are participating in importing from Russia. So it's an interesting fact in terms of the global geopolitics happening, Stephen.
I mean, it's amazing watching the sort of scramble at the moment. You've got China, the US kind of retreating in some places, and then you got Russia looking for influence too.
And that's what I always say. There's never a trade vacuum, Stephen. Unfortunately, when there's a vacuum, somebody fills it. And I no longer call it a scramble. I say there's a stampede now for Africa. The good thing is that we're at the table one way or the other. The question is how much slice of the cake are we getting? That's another discussion.
Alexander Zanders is turning unbankable farmers into a massive opportunity. How's he doing?
And it started off as a COVID project. So during COVID, he went and bought 100 acres of land. That's in Nigeria. And what he picked up was that there was a potential gap of about $100 billion in terms of facilitating credit for unbankable farmers. And if you know, Stephen, probably about 80% of the agricultural sector in Africa is driven by the SMEs, farmers who can't scale, but who've got the potential to grow. So he's created a credit facility that will check and allow farmers to be invested in with minimum security. It's probably about, at this point in time, Stephen, he's secured probably about 17,000 farmers. Corporates, Nigeria, Senegal, and Liberia have come to the party with about $6.8 million. But at the end of the day, the total potential value is about $100 billion, which is quite significant. And he's also attracted the attention of Pharrell Williams, the singer, through his entity called Black Ambition, who have invested. So it's a good story just in terms of stimulating the agri-sector from an agri-tech perspective, because it's leveraging of technology, data, which makes a significant inroads in terms of the value proposition.
Now, the Zimbabwean billionaire Simon Rudlin, now there's a guy waiting for a Netflix miniseries, eh? He's invested in this new citrus plant near the border with us.
It's actually, well, remember he did the headlines with the gold mafia story.
Yeah, and Hewlett Tongard as well.
Hewlett Tongard, he was all over. So, and somehow he never gets convicted, so he's still theoretically innocent. But he's invested in a $25 million plant in Beitbridge, which is on the Zimbabwe-South Africa border, for citrus processing.
It is so hot there. Why would you put a factory there?
Well, from a logistical perspective, Stephen, if you are relying on imports and exports, remember everything kind of converges at Beitbridge, but it is hot. But they've currently employed about 350 people, and they're looking to scale to 1,500. The investment vehicle is called Orangeville, very, very innovative.
Was Citrus Dal already taken? I think it was.
Look, with the heat in Beitbridge, there'll be a lot to drink. But ultimately, from an infrastructure perspective, a great story. From industrialization perspective, a great story. Remember, he also invested. He's also got tobacco, but again, there's a lot of controversy around that whole operation. And that's the dynamics of Africa. You know, there's an opportunity, but also a lot of challenges. So let's see how the story plays out. But at the moment, it's happening in Beitbridge, believe it or not, and it's quite close to home, Stephen.
No, very close. It's about okay. Madagascar, they're missioning for megawatts. How's it going?
Yeah, Madagascar, I mean, Stephen, it's a small island. I mean, obviously famous for that animation, but there are huge challenges.
What a history before that.
Yeah, there's more history before that, definitely. But I think one of the big challenges that are there, Stephen, is that only 36% of the population have access to electricity, and they're and they're hoping to scale this to 80%, but significant challenge. The current legislation and governance is not helping. The World Bank has injected plus or minus 250 million to initiate a mechanism to support them. But at the end of the day, because they are on an island and there is isolation in terms of the geographical ecosystem of Africa, they feel the pain a bit more from a power perspective. And there's a huge potential for them to scale up. So hopefully they'll get over this leg. But currently that's a big challenge in Madagascar.
And then in Sao Tome and Principe, the plantations, I didn't know there were plantations there. They're on the World Heritage List.
Yeah, UNICEF has recognized them from the World Heritage locations, Stephen, 2 plantations that go back to the colonial history and were related to the significant production of coffee and coca production. And what has happened is the leadership, both from a political and private perspective, has said, look, we realize we're a colonial history, but there's a lot of things to be learned from there that will stimulate us going into the future. So the population of Sao Tome and Principe is probably about 200,000 people, but it stimulates not only education, but also tourism. And this goes back to 1975. So it's a good story, albeit obviously painful from a colonial perspective, but they've embraced this in terms of saying for us to go into the future, we have to learn of the past. And so it's a great story from United Nations that they've realized it as a UNESCO heritage site.
Rotendo and Dingby, thanks very much indeed. Good to see you, founding director at Tribe Africa Advisory and author of the book Rumble in the Jungle Reloaded. You must shake hands with Sia Morta. Just because he's standing in for Aubrey doesn't mean that we're not as polite to him.
The competition.
Yeah. Okay, it's just gone 28 minutes after 7. Rotendo, thanks.
The Money Show.
Personal Finance with Warren Ingram.
26 minutes now to 8 the time. Well, one of the things that can happen to you in life, it's a dread disease in some ways, is lifestyle creep. You think that you've got a bit more money than you did, and you do have a bit more money than you did, but actually you don't have any more wealth. You find that it seems to have disappeared somewhere. So, in other words, you're not more financially secure. Warren Ingram is the certified financial planner and co-founder at Galileo Capital. Warren, good evening. I mean, this is quite interesting. So you might get a bit more money in your bank account every month, but you're not really feeling any richer. It's quite a common disease.
It is, and I love your phrasing. It's a dread disease. It's one we should all avoid and do our checks and make sure we keep ourselves healthy. So what happens, Stephen, is you get this increase, and potentially weren't really planning on it, and it's exciting, and so in that first month, you get that sort of injection of happiness, and you think, well, it's not a big, it's not like I've suddenly got a massive bonus. It's just an increase in my salary. And so you think about whatever it is, the subscription, the streaming subscription that you were kind of debating last month, but didn't want to spend the money on. There was that car that you were thinking about that just wasn't affordable, and suddenly it is. So it's those kinds of things where you kind of gradually ease your way into spending a bit more money, and so it's not just a big event. It's a kind of and I think the name is fantastic. It's a lifestyle creep. It just creeps up on you.
So, I mean, one of the things about this is that when you get an increase, it's perfectly rational to think, and I think human to think, well, look, I've been working really hard for this. I've been working extra hours, and often if you get an increase in monthly income, it's because actually you've been working more hours than anything else. And therefore I deserve this, or I've actually worked for this. Or it's just a little thing. Why would it have such a big impact? And yet that's the creep in this, isn't it?
Yeah. And I think, the psychology is right, that we feel we're entitled, that it is our money, and we've worked hard for it. So what's the problem? And I get the psychology, and certainly, this is the money show, not the Grinch show. We're not going to steal all the joy out of life. And so I think just to say, you should feel that. You should feel some reward from this, and you should certainly benefit. But at the same time, you should just be very aware that what you're doing, if you allow this money to kind of just drift away over time, is you're not building wealth. You're just creating kind of future problems instead of future solutions. You're enjoying something now and relaxing a bit more now and getting a little bit of a kick now, but you're not solving the problem of financial freedom, retirement, building up a wealth pot. You're just spending more, and that's the thing we've got to be very careful of.
Okay, so the other thing is that some of them, it's not a once-off. It's not like you're buying yourself an ice cream. You're buying yourself a kind of recurring ice cream, right? These little upgrades, these little things are actually permanent quite quickly, and often permanent from the beginning.
Yeah, I think it's the thing we just don't conceptualize. So let's use the example. You get a 50,000 Rand bonus, and you reward yourself by blowing it all on tons of ice cream and a nice holiday. Next month, you're earning your normal salary, and the bonus is spent, and so your lifestyle costs in the next month haven't changed. So the money was a once-off thing. You spent it, it's gone. But contrast that with buying a bigger car, a more expensive car. What happens now is you're going to pay more on insurance. At some point, you're going to have to buy replacement tires. That's more expensive. At some point, you're going to have to pay for maintenance. And all of those costs are going to be higher on a bigger, more expensive car than the car you had. And so that's not a once-off cost. It's now a repeated cost. And unfortunately, it's a cost you lock in for life, because once you buy the bigger car and you reward yourself, it's very difficult. I would argue for a lot of people, they don't go backwards. You don't go from the tiny little 2-door to the big 4-door and then back to the 2-door again. You kind of stay in the big one. So what you've done is locked in a more expensive lifestyle forever.
Okay, so that's really the difficulty here. All right, how do you survive lifestyle creep? We're speaking to Warren Ingram, as you know, the co-founder at Galileo Capital. Your questions from an 011 883 0702 and 021 446 0567 in personal finance tonight. Your voice notes too on 072 702 1702. Why does it feel, there's a funny human thing about this, Warren, that it kind of feels normal. So, I mean, the moment you get into a new car, it's very exciting. What happens after that?
We're there's actually a name given to this phenomenon. So the psychologists call it hedonic adaptation. And so what happens is...
hedonic adaptation, there's a phrase I'd never heard.
And we've got to talk about nominative determinism after this, but let's talk about hedonic adaptation. So hedonic adaptation, we get we buy the big car, or maybe you go and buy the phenomenally expensive house that's on the Atlantic seaboard, and you look at the sea all day. What will happen is the first day that you wake up and the new view, it looks amazing. By the third day, it's still exciting, but it's not as amazing as it was on the first day. By the third month, it's just your view. It's the thing you see when you wake up. And by the third year, it's just your life. And so our brains very quickly adapt to the circumstances that we're in. So if we're in the bigger house, we're driving the bigger car, we don't get the same kick that we did on the very first day. In fact, we get no more kick. We go back to the baseline that we had, when we lived in the smaller house or drove the smaller car. And so that's the ability of our brain to adapt to circumstances. It does actually happen in reverse as well. We can adapt to kind of very bad circumstances, and those become normal. But with lifestyle creep, what happens is our brain just gets used to it, and there's no more cortisol kick. There's no more fun and enjoyment. It's just life. It's just another day. And so, and that happens really, really quickly. And so that's sort of, the kick that you get from buying things bigger, better, faster. If that's how you kind of stimulate your happiness, unfortunately, you're on an endless race on a treadmill that will just never take you anywhere, because now we know that that's just going to become normal again. So if you weren't happy before, you feel happy for a little while, but then you go back to being unhappy again. And that's how our brain is wired.
Okay, there's another thing that happens, which is when you earn a little bit more, you tend to mix with people who earn similar to you, and now you need to kind of keep up a little bit, and you spend like they spend. What happens there?
The best examples I can think of are the people that are, either trainee accountants or trainee lawyers, and they are called articled clerks, and they go from being articled clerks to now the qualified accountant, qualified lawyer, qualified doctor, whatever it is. And so now they move into the realm of the qualified and the professional. And then they look at all the people around them, and they're all driving better cars than the newly qualified person is. They seem to wear fancier clothes. And so you think to yourself, well, hang on, I better measure up here. I better stack up to these people. And so you do. And so now all of a sudden you're adapting to the new circumstance. You've had the jump in income. You've gone from being a regional manager to a general manager, whatever the thing is. Now you live like that, and you now benchmark yourself against those people, and suddenly you're now in a new normal. And what we don't really realize is, we think, everyone around us that's in a similar sort of position, driving the big car and the fancy house, we think that they're doing that, with cash, not with debt. And what we don't realize is, but behind that facade of success is usually someone in an equally compromised position and who's kind of scrambling just to kind of stay still or maybe keep their head above water.
Excuse me. Isn't this the secret to life, is that all you know is what you see of a person and what they choose to show you. You have absolutely no idea about the true state of their financial affairs, and you will never really know. The only person whose financial affairs you might know are the person you live with, your spouse.
Yeah, and if you've got a good relationship with your parents, potentially they'll have done a good job showing you what how life really works. But I think that's the thing. We get into this this comparison situation where we want to see ourselves stack up against our peers, and unfortunately something like social media just gives you takes this whole urge and puts it on steroids, because now all of a sudden we also just see people living their best lives on social media, and we feel inadequate by comparison. But what we don't see is the other side, the things that they're struggling with, and inevitably they've got financial issues. We know this because somewhere around, I'm exaggerating maybe slightly, but it's probably 5 to 15 out of every 100 salary earning South Africans get to retirement safely. The rest of South Africa gets to retirement having earned a salary their whole lives without enough money to retire comfortably. So we just need to know that this comparison thing, it's absolutely lethal. And comparing yourself to the person next door is probably the worst thing you can do if it's causing you to spend more to try and match what they're doing.
It's also the secret to life. And man, if someone could teach it to me, I'd be very grateful. To not care what other people think of you, to not feel the need to keep up with, in England they would call it keeping up with the Joneses. There are lots of different ways of putting it, but to not feel that. If you can just be happy with what you have and concentrating on your own personal goal, well, then you're going to be quite happy.
I think that's really the key to kind of finding the secret to good money management as well is, once you kind of stop looking around and you start saying, what is it that I really want to do? What is it the life that I want to live? And, going forward, where would I like to live one day? And how would I like to live my life? And I guess, understanding that it must be realistic, don't kind of come up with crazy dreams that make you unhappy forever. But we only get really dissatisfied when life doesn't work out against the thing we expect, against our own expectations. So the key here is to say, I'd like to be able to get to the point where I don't owe anybody any money. I get to and that's a very good goal to work towards. You can do that by limiting the debt you take on. Once you've hit that goal, you're probably better than 8 out of 10 salary earning South Africans already. So if you do want to do a comparison, that's a fantastic one. Then you start to say, well, now I'd like to build up some assets so that one day my money looks after me. That's a brilliant goal to have, and by all means do it, and you can do it relatively cheaply. And what you're not doing is saying, I need this branded clothing, or I need this kind of a car, because those are the things that take you down the road you don't want to go.
Okay, so how can you enjoy life free of the dread disease lifestyle creep?
I think the first thing is, the next time you get an increase, before you do anything, if you get a letter or however it works in your business where you're going to get a raise, the very first thing you do is set up a new debit order, so that if you get paid on the 25th, on the 27th of the month, you run a debit order off your account and it goes into an investment in your name. So you're now starting to pay your future self. And let's just make it a round number. You're going to get 10,000 Rand a month more in your bank account after your increase. I'm not saying that you take all of that 10,000 and put it into your savings and investments. That would be amazing if you did. But you do want to reward yourself and you do want some joy. So take 5,000 out of that increase and commit that to a debit order, so that when the money is sitting in your bank account and you've just got paid, the very first thing that happens is your debit orders go off. You've now paid your future self. You're taking care of business. And then the other money that's sitting in your bank account, you can now spend relatively guilt-free. And so you do get the benefit of the hard work that you're putting in, and you do get to enjoy life a little bit more than you were in the past, and raise that standard of living if that's what you want to do. But what you know is that you're also looking after yourself into the future. So you are starting to build wealth and not actually making yourself poorer. Because I mean, the really sad thing here is that you take that increase to justify taking on more debt. So actually, 3 months later, you're actually poorer than you were go at the beginning, because you've bought an asset, but you've actually got even more debt. And so net asset wise, you're backwards. That's a tragedy.
Sure. Okay, so, I mean, one way of doing it, I suppose, is to split the raise between the future you and the current you. They're both for you, but one's a little later and one's now.
Yeah, and give yourself a reward. Just saying to yourself, okay, I do deserve something nice, and I've been kind of wanting to go on that holiday for a very long time. So now that the half of the increase that you're now going to spend, you can set that aside on a holiday if that's what's meaningful to you. That's a great thing to spend money on. But what you also know is that you've set aside money that's going to start building and compounding in your favor. And I think that's the way that people can enjoy life along the way, but also knowing that they are taking care of their future selves.
All right. Your questions for Warren, 011 883 0702 021 446 0567, and voice notes on 072 702 1702. One's come through from Pravesh saying, hi, I'm 29 years old. I finally got to the point where I can save some money every month. I'm confused about the difference between buying ETFs or unit trusts. Is one cheaper or safer than the other? What's the actual difference between an ETF and a unit trust, and how should a beginner choose between them? It's a great question, Pravesh. We'll have an answer for you with Warren in just a moment. 10 minutes stay.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking, turning intent into execution. That's how ABSA are invested in Africa's energy future.
The Money Show.
Personal finance with Warren Ingram.
Well, your questions for Warren Ingram. Lifestyle creep, of course, is what we're trying to avoid tonight. Pravesh's question, I'm 29, I can save some money. I'm confused about the difference between buying ETFs or unit trusts. Is one cheaper or safer than the other? And what's the difference between an ETF and a unit trust, and how should a beginner choose between them? It's a wonderful question from Pravesh, Warren.
I love it. And I think there used to be a huge difference between these, in kind of 10 or 15 years ago. But over time, well, maybe just to start, the history is that exchange-traded funds were launched because unit trusts were simply too unwieldy, too expensive, too difficult to actually access and invest with a small amount of money. And so exchange-traded funds were launched, and the way one buys an exchange-traded fund, a stockbroking account. So most of the banks have a platform where you can, on your app, you can buy a share or an exchange-traded fund, and you can do that with once-off money. So you can do that with a relatively small lump sum, and you don't need to commit to a monthly debit order. So what we found years ago was that, kind of young people starting out would really respond to exchange-traded funds before they would buy unit trusts, because unit trusts were expensive and clunky. And so what happened is the unit trust industry didn't stand still. They looked at this and said, well, hang on, we're going to lose out here. And so their fees have come down quite significantly. So I would say that it wouldn't be right to say that one's cheaper or safer anymore. I think that they're just a little bit different. And my biggest guidance to Pravesh would be, if you've got a monthly amount and you just want to do kind of a fire and forget solution, where you're saying, I want to set aside a debit order, I'm going to pay like 3,000 Rand a month, and I just wanted to know it's going to go into a good long-term investment, then I think a unit trust is probably the right way to go, because it certainly works better with monthly amounts on a fixed amount every single month. And I like that idea because it's fire and forget, and you're not tempted to spend the money. But if you've got a bit of extra money and it's irregular, maybe you don't get a fixed salary every month, then committing to a debit order might be a little scary. And in that instance, an exchange-traded fund is probably a better idea, because you can put 5,000 Rand this month, and next month you do nothing. The following month you put in $1,000, and so you can always put in ad hoc amounts when it suits you. So you don't get the discipline of a debit order going off your account automatically. But if you don't have the stable income, then maybe look at an exchange-traded fund. Or if you get paid once a year, you get some kind of a big bonus, and you don't have money through the rest of the year, then maybe an exchange-traded fund is the right way to go. But I think they're both actually legally, as safe as each other. So it's going to be which one you choose. And I guess, if you've listened to the show, you're going to know, I'm going to tell you to buy a South African index and a global index, and make sure that you spread your risks. And that's probably the best way to get the safety aspect. But that would be the way I would choose, is basically how you get paid and how you can invest.
Sure. Thank you for that. Yeah, very interesting answer. Okay. Lifestyle creep. Are some upgrades worth making? You basically been quite clear that we need to be very careful, but are some upgrades worth making anyway?
Yeah. So one thing that we've learned over time is that people don't get a rush out of buying stuff. We get a kick for a week or a month or something, but after that we go back to kind of normality. But one of the things that does make a big lasting impact on our lives is buying experience, paying for an experience. And for some people that might be kind of a hike up a mountain, and for someone else it might be a holiday with friends, where you go and do the migration or something. And what we buy with that is the experience of the trip and the holiday, but we also buy a lifetime of memories that we can kind of go back to time and time again. So spending money on an experience that, it's something that's meaningful to you is something that tends to be money well spent. It's something that adds to life. It usually, especially if it's something like travel, we tend to learn a bit more. We tend to grow as human beings through that process. And what you know about that is that it's not a cost that keeps recurring afterwards. It's not like a car where you've now got to maintain it. It's a holiday. You've bought it, you've paid for it, and it's done. But it keeps giving you that bit of joy and a shared experience with the people that you went on. So I think that those are things that you should buy and pay for yourself. But try to avoid the things that are going to cost you money every single month, every single year, and maybe that those costs increase, because that's the very definition of lifestyle creep. That's where you trap yourself into a very big expense that will just keep taking money from you month after month, year after year, and robbing your future self.
So I suppose the feeling is it's all about, as so often with what you pose to us, how are we going to feel about it, not today, but in a year's time or even after that? And that's really the question.
Yeah. And if you're sitting there and you've got the increase and you want to go and buy something, then maybe do one thing, which is kind of give yourself a week and say, well, okay, if I still really want to buy this thing in a week's time, how will I feel? And, if you're as excited in a week's time, then maybe consider it more carefully. But if after a week you might look at it and go, actually, I don't really need that new phone or that new TV. The one I've got is perfectly fine. And it's actually, I'd much rather put the money towards a nice trip one day. And so you can give yourself a bit of breathing room before you make the decision. But, if it's something that's going to give you joy for a long period of time, it's something that's usable and reusable, and maybe something you can share with family, then maybe it is the right thing to buy.
Sure. Yeah, so interesting to look at. Warren Ingram, thank you. I really appreciate that. The co-founder at Galileo Capital, as always, so many important answers to really important questions, fundamental questions about life, I think. So, Warren, as always, thank you so much. Really do appreciate it.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking, turning intent into execution. That's how ABSA are invested in Africa's energy future.
Well, the strong rally continues in the US. The Dow Jones is up 1.98%. The Nasdaq is up 2.61%, and the S&P 500 is up 1.88%. Obviously important reasons for that, particularly around AI optimism. Hope still of a peace deal in the Middle East, I think, is driving some of the markets as well, and that seems to be giving everything a little bit of a kick. So that does seem to be driving the market. Just to let you know, a statement now released, it seems, by the Finance Department, the actual Treasury, and talking about the PIC judgment that says that Patrick Lamini is now to be reinstated. And I'll quote from the statement: the minister believes this judgment vindicates the actions taken by National Treasury and Cabinet to restore governance at South Africa's largest asset management institution. The actions were both good and necessary, triggered in part by the hasty removal of Mr. Lamini without due consultation and process. It would seem to me, based on the reading of that Patrick Lamini will be back to stay at the Public Investment Corporation. We'll be back tomorrow. Good evening. It's 8 o'clock.